All right. So, hello everyone. Today we will be discussing everything about mortgage lending. If you're a first-time home buyer or thinking about buying a rental property or refinancing your home, you're going to have to work with a mortgage lender. And if you want to be an informed consumer, then stay with us for the next half an hour. And with us today to help give us the ins and outs of mortgage lending is Michael Parsons. Mike is the chairman of Apex Home Loans based here in Rockville, Maryland. I think I was just asking him, I think they're almost 30 years in business now,
Yeah.
over 150 employees. I've known Mike probably around 4 years now. We went to
Leadership Montgomery together, and I think
Leadership Montgomery together.
yeah. What was our class? I got it right here. We were class of 2017, so
Class
it's
of
coming up on 4 years.
2017, the first,
Yeah,
I forget what our
the
acronym
first
is, the
class.
first class.
Not
And
the first
I was
class, but the first class with the new executive director, right?
exactly, yes, Marie
Yes.
Taylor. And I just learned about this. I was reading your resume. You also, I don't know if this is actually still true, but you're currently serving or have served as the board of governors for the Maryland Mortgage Bankers
Yeah, Maryland
Association.
Mortgage Bankers Association, the Mortgage Bankers Association, Metropolitan Washington.
Yeah.
I'm currently not on the Maryland one, but I'm on the one still at the Metropolitan Washington. It's just important that you stay involved and stay engaged with your industry to make sure you follow the ins and outs and you don't miss out on any integral part that might be something of value that you can share with your consumers or your employees.
Right. So I'm really looking forward to this, Mike, and thanks so much
Yeah.
for being here today. I feel like mortgage lending is such a key component in the whole process of buying a house, and it's just
Yeah.
really important for the consumer to just understand what the ins and outs of
Yeah.
mortgage lending is all about. And we are just doing this live if you're tuning in right now. So if you have any questions, feel free to type it in the YouTube comment section. So I'm gonna just go ahead and ask my main question. I have a lot of
Yeah.
questions for you, Mike, today.
Yeah. We're ready for it. So excited to be here. And you and I've been talking about doing this for a while now, and I'm glad to see it's coming to fruition. So I'm excited too as well. And be candid. Ask me anything you want. I'll do the best I can to give you the most accurate answer. And if I can't get it for you, I'll get it, and we'll follow it up with everybody online later.
Sounds good. So, Mike, I noticed I was looking at the mortgage rates yesterday, and it looks like rates have actually been dropping since November 2018. And I think last week, the 30-year mortgage hit an all-time low, I think below 3%.
Yeah, it started with a 2. It's pretty amazing, right?
Right. And
Who would have thought that?
And now that I think about it, I was at a financial planning conference. I don't know when it was, like May. I don't know if it was 1 or 2 years ago. They were talking about rates like really shooting up, but now it's the complete opposite. So yeah, tell us a little bit more about that. What's going on? And
yeah, absolutely. Absolutely. Well, to paint an even bigger picture, I got in this business right out of college in 1991. And I know I'm not that old, right? But when I got in, rates were right around the 7% range, and then around 94 they shot up to 9.5%. And I remember saying to my employer at that time, "How am I going to sell a rate of 9.5%?" And then I quickly got pushed back, saying, "Well, remember back in my day they were 14, 15% back in the 70s." That quickly quieted me up. But I bring that back up again because since 94, it's been a slow drop downwards, to the point where we've bottomed out in the last week and a half in some instances, the low to mid 2s. Who would have ever thought we'd have mortgage interest rates, long-term debt being sold and bought by us as consumers to finance our homes in the 2s? I mean, it's incredible. And the lower the rate, the old adage is, the lower the rate, the lower the payment. The lower the payment, the more home you qualify for. So with income levels increasing through appreciation throughout the years, and values of the homes going up, but interest rates going down, it's enabling more and more folks to buy more home for the dollar. It's a pretty incredible opportunity right now for sure.
So it's great for the consumer, great for those who are buying a home or a property or refinancing.
Yeah.
So I guess is it for you, for someone who is buying a home or refinance, I guess it's one of the best times to do that right now. Would you say?
Well, from an interest rate perspective, it's never been better. From an inventory perspective, it's extremely challenging if you're looking to buy. To touch on that just a little bit, a healthy market has an inventory amount of 6 months, meaning it takes 6 months for the entire inventory to be flipped. In the marketplace.
Okay.
We're now, please don't quote me exactly, but I think we're under a month of inventory.
Wow.
So you're finding a multitude of buyers quite often putting offers and contracts in on the same home, which makes it extremely difficult for the homeowner, and even more difficult for the first time home buyer, because the when you have a multitude of buyers, as a seller, if you can picture this, you want to take the contract to buy your home that bears the least amount of risk. And the least amount of risk comes obviously when somebody's buying your house for cash. Believe it or not, there's a large percentage of the population that has the wherewithal to do that. So you have to think about what's the next best thing. So preparing yourself for home ownership long before you're ready to buy, getting your financing in order first, reaching out to your lending institution first to find out what you can qualify for, and that amount plays an integral part in what you're trying to do in the long haul in terms of buying the home. So it plays a very big role nowadays.
So being prepared and line up your finances to make sure you're in a better position than other buyers, because it's a competitive market right now. I guess no one is really, not a whole lot of sellers, a lot of buyers.
Yeah, there's not a lot of sellers, with this pandemic, which I'm sure we'll touch on too as well. There's a lot of people that are scared to sell their home. They don't want to go anywhere else right now. But if you look at the millennial population, they're approaching their 30s and into their 30s in a lot of instances. It's the biggest population, the biggest demographic that's ever coming into the housing market, and they're just starting to do so now. So when you have the older generation, that's in their forever home, or maybe they're next to forever home, doesn't want to sell yet because of the pandemic, and yet these these millennials that are ready to buy, the downside is they're driving the prices up of homes because there's so many people wanting to make offers that it's in some instances it's forcing the seller to sell because they're getting a price that they never would have gotten before. Got it. So it's really important to have your financing in place, have the approval of someone like yourself as an advisor. I mean, I always say the best place to get your referral to a mortgage person like myself is to go through your advisor, because your advisor knows your whole picture of what's going on for retirement, Social Security, everything you can imagine. So why not seek the advisor's guidance as to what's best for you in your situation, and then obviously have a good realtor representing you.
Right. I totally agree. One of my clients asked me this. So when you're working with a realtor, you're about to buy a house, or you're even trying to refinance your home, there's a lot of options out there in terms of either banks or brokers where you can get a mortgage. If you're doing that, how do you start in your search for a good mortgage lender? Because typically what ends up is whatever your realtor recommends, that's where you'll go. And that may necessarily be the best option. So what should people be looking for when looking for a mortgage lender?
Yeah, great question. I'm a big believer and have found the most success voiced from those that have worked with somebody they know, like, and trust. So, the internet is a plethora of information. So what most people tend to do nowadays is they just quickly go to the internet, which is great because it gives you an idea. But before you make that final decision, reach out to somebody else that's gone through the process. Reach out to your financial advisor, find out who they would recommend, and get a second and third quote. Just in the end, we all get our money from the same place. Rates could be different by an eighth or so, but not much. So what a homeowner wants to make sure is that the person they work with is going to hear their story, because every home buying journey involves a story of what those individuals are trying to do. Someone is going to take the time, listen to their story, provide a level of service that's going to bring comfort and understanding. So when they do go and buy it, maybe they don't have the best interest rate, or maybe they didn't pay the cheapest fees, but they're going to have thorough knowledge of the investment they got into to make the right decision for themselves.
So
definitely someone like you already know of, like, and trust.
Someone you can trust, and obviously there's the numbers in terms of the rates and the costs, but someone you can trust and know who's gonna give you a good, high quality service.
Yeah, I mean, it's the biggest investment a family usually makes in their entire lifetime.
Yeah.
You know, don't try to wing it on your own. You'll find somebody that's already done it and had a great experience. Really.
Got it. So there's the down payment that people need, and my understanding is you need at least 3.5%. Typically, if you want to avoid paying mortgage insurance, you put a 20% down payment. So it's a whole range, right? So if you're talking about a $500,000 property, if you want to pay 20%, you need $100,000 in
a lot of money,
cash, and not many people have that. Some people do. So I guess in your business, 3.5% all the way up to 20% or even more. How much down payment do you think people should have when buying their home?
Well, I mean, ideally the numbers speak for themselves. I mean, if you get to 20%, you're able to get to 20%, you're going to avoid what can be a pretty expensive monthly mortgage insurance charge. But, you know, there's been this misnomer in the industry where people look at the mortgage insurance as a negative thing. It's not really negative. It's a vehicle that's there to enable somebody who might not have the 20% to put less down. That's the way people really need to think about it. And you can go as far down with a typical Fannie Mae, Freddie Mac product as 3% down. Right. If you're a veteran, thank you for your service, but you can get in with no money down, much less no money out of pocket. So there's definitely a lot of options for you there that you need to entertain before making the exact decision for you. The problem for most with getting the 20% down is they end up, especially the first-time home buyer, is they're using all the cash they have, all the gift money that mom and dad might be fortunate enough to give them, and then they get into the property, and then they're stuck because they want to paint a room, they want to buy furniture, and now they're cash poor. Right. So it becomes extremely difficult with that. So again, work with your mortgage lender ahead of time. Go through the options. Here's how much money I have. Here's what I want to do once I take possession of the property. How much will each one of these products at a 5% down, 3% down, 10, 20%, whatever it is, what is it to leave me at the end, to leave me in a comfortable position where I can live a nice, comfortable life and enjoy my home without the stress.
Got it. So consider all the options. Yeah. And I think for our firm, when we work with a client on this process of home buying, we also run some scenarios in terms of what's going to be the monthly payment. I think you would probably run the same one and just think about what makes sense in terms of their finances. One of the things that I actually just learned recently is, and correct me if I'm wrong in this, Mike, so interest rates would be lower if your balance is higher, or does that apply to just refinancing or also for first-time home buyers?
No, that's not necessarily accurate completely. It can be lower with a higher balance, depending on what the value is of the property. So you could have a $100,000 loan with a $105,000 value and have a higher rate than a $400,000 loan with $1 million value.
Okay.
Does that make sense? Okay. It's all about the margin of equity that resides in the property. There's other factors that come into determining interest rates too, as well, like credit score, type of property, location, and so forth. But in terms of loan amount size, it really depends on the amount of the margin, the spread between the loan amount and the value of the home.
Got it. So the value of the home, the balance, and other factors will affect the interest rate. Okay.
Yeah, credit score, it's another big one. Right. Obviously, it's probably the biggest one of them all. All of them play factors in it. So my advice to those out there in the audience is just because they see a rate on a screen or on a newspaper or somewhere like that, it doesn't mean that's the rate. That's a teaser rate to grab your eyeballs, grab your attention, make the phone call. Right. But there's going to be other things that are needed in order to determine what your actual rate would be.
Got it. Yeah. And what about for investment property? So one of our clients is thinking about, well, actually, two of them are thinking about buying rental properties. And so my understanding is for rental properties or investment properties, your rate is going to be higher compared to if you're buying a property as a residence.
Correct.
Is that correct? And is it usually like a full percentage point, or?
No, it's about a 0.5% difference.
0.5%? Okay.
And it has everything to do with market risk.
Okay.
You know, if you go back to the Great Recession back in 07, you know, when we had all the foreclosures and short sales, if you really dug into the details quite a bit, you'll notice that a vast majority of the properties that were given up or walked away from were investment properties or second homes.
Oh, okay.
So that's why the spread, the margin is a little bit different from a primary residence, less risk because who's going to give up their shelter for themselves versus something that's not really theirs. They're using it to generate a rate of return elsewhere. So the markets take on the risk by that, and they offset it by charging you, the consumer, a little bit more interest rate. It's only 0.5%. It's not too terribly bad for that. But on a purchase price, the biggest difference there is not just the 0.5% when you're buying an investment property, but also the down payment amount. In most areas, you need to put upwards of 25% down to purchase an investment property these days.
25%?
25%. Yeah.
In order to
purchase no, this is just to purchase an investment property.
Oh, okay. Got it.
They're trying to spread out the risk, because can you imagine buying a $200,000 investment property with minimal equity, and then all of a sudden seeing a downturn in the economy and there's no equity left in that property? A number of consumers out there would just walk away from that. And to walk away from a mortgage, it might sound good for the person who's walking away from it. They can deal with their credit being adversely affected for half a dozen years or so. But financially, the banking institution that's holding that is the one that takes the brunt of it. And then they have to adjust and hedge. So then it adversely affects their lending ability. So then it ultimately trickles all the way down to the average consumer. Got it. The way to mitigate it is just have the requirements to be a little stricter. Yep. Not everybody can afford to buy Warren Buffett's Berkshire Hathaway stock, right? You know, it's tough. You got to be more responsible, and you got to have the wherewithal to. Same instance here.
Now, staying on the topic of interest rates, right before we went live, Mike was sharing something about recent news from the
FHFA.
So tell us a little bit about that, Mike, because I think it's going to impact a lot of people.
Yeah, it's pretty big news that came out last night after hours, conveniently, where the markets were already closed and we couldn't take action beforehand. But FHFA is the Federal Housing Finance Agency, and they're the agency that oversees both Fannie Mae and Freddie Mac. So they basically tell Fannie Mae and Freddie Mac what can be done and what cannot be done. So in the MBA, the Mortgage Bankers Association interpretation of what they did is they essentially increased their profit margins at the FHFA, Fannie Mae, and Freddie Mac by 50 basis points, or 0.5% in cost, not in rate, but in cost, on all individuals who are refinancing homes at this point in time moving forward. New loans taken today forward. So essentially, if the costs went up by 0.5%, that means companies can't absorb that. So it's ultimately going to be passed on to the consumer. So which is going to, in the end, the impact is going to be higher rates, slightly higher rates, not 0.5%, maybe an eighth, maybe 0.25% higher.
Yeah.
But it's just unfortunate when the whole purpose with what's going on now as a result of COVID was to keep housing moving, which is really the one industry other than the secondary markets that's really keeping the economy going at this point in time. And then just all of a sudden handcuff it by charging this added fee that's ultimately going to make its way down to the consumer. It's an unfortunate occurrence that's occurred. We're trying to fight it. So if anybody out there hears about it, please help us fight it too, and take to social media, take to your senators, and then let them know how this could possibly adversely affect you.
Right. That's a really unfortunate news when I heard about that, because it's going to impact those that are trying to refinance, buying their first home.
Well, it won't affect anybody buying a home. It's only for refinancing.
Oh, just for refinancing.
Just for refinancing. Yeah.
Verifying that.
Yeah.
Okay. Interesting.
Yeah. Arguably, through the MBA, they stated that it's an individual refinancing their home is far less riskier than someone buying their first home. So why would you penalize someone who's trying to lower the rate, save money, establish more cash flow that they're ultimately going to put back into the economy.
Right.
To pad your own pockets. So it's a tough spot. We're fighting with it. We're trying to deal with it, but it's unfortunate, and the way they went about doing it is it's unfortunate as well.
Are they just trying to raise money for their agency, or I don't know what they're trying to do here?
Yeah, they're saying it's an adverse impact due to COVID
in
the marketplace, but I mean, come on, it's they're making record profits right now from the amount of people that are refinancing. Do they really need to pad it even more at the expense of the consumer?
Right.
It's somewhat selfish. And like the phrase that's going out there now, we're looking at it as a pure agency cash grab. Money's out there to be made, so they're grabbing it.
I like that term.
At the expense of the consumer.
Cash grab.
So yeah, it's unfortunate.
Yeah, that's really unfortunate. So I wanted to segue a little bit. When I look at our clients' documents after they receive a refinance quote from a lender, so obviously we look at the interest rate, and then there's this whole list of closing costs.
Yes.
That vary from lender to lender. So maybe educate us a little bit. What are those closing costs, and why might the closing cost of one lender differ from another?
Great question. And the closing costs are made up of a whole plethora of items. It's to touch on a few. There's obviously taxes to acquire a property. That's in there. There's insurance that's required to insure the transaction. There's an appraisal that's needed to make sure that the buyer's not overpaying for a property. Mm-hmm. Credit checks to make sure that the consumer's credit worthy, maintains a proper credit score. And there's various other fees going out to third-party individuals that help us tie the entire transaction all together. But mostly taxes and insurance are the two biggest ones that you'll see. Mm-hmm. In terms of fees from lender to lender, broker to broker, they should all be within a couple $100 of each other. I mean, if you see that big of a disparity, I would look at the interest rate, because typically if someone's offering a much lower fee, they're charging a slightly higher interest rate. Right. And fees can be absorbed far quicker than the 30 years extra that you're paying on interest over time. Right. So I'd look for the better rate versus the better fee. But ultimately, when you're putting the two together, it's the rate, the fee, and it's the assurance you're going to have in what you're walking away with through the comfort that you've obtained with the individual, and knowing you're going to get the settlement on time in a manner that you expected or need. Got it. So that factors into, because I think if it takes a while to settle, then maybe it wasn't the best choice. Yeah, absolutely. So you really want to work with a lender that maintains complete control, especially in this market. You may or may not get the best rate. I mean, it's hard to ever get the best rate in the market. It's kind of like timing the purchase of a stock, right, Alvin? If I tell you I want to buy Apple at $200 a share, can you guarantee me it's at $200 a share? No, the market determines it when you put the order in, right? So it's kind of the same thing. I can tell you we're going to get you 2.75%, but mm-hmm. until we have all the data and we execute the order, right, you really don't know what you get. Right. And which reminds me, I think one of the unique things that I remember you saying about your company, Apex Home Loans, is, do I understand this correctly? You guys originate the loan yourself? We originate the loans ourselves, self-source it, we originate it. We process it, we underwrite it, we fund it, we do everything. We service it typically for the first mortgage payment, and then we sell a vast majority of them off to the agencies, Fannie Mae and Freddie Mac, FHA, VA. But you still service the loan? Typically for 1 month, then we sell the servicing rights. Okay. So is that, and I noticed that happens to, like, one lender sells it to another. What typically goes on in that? I mean, why would you want to sell the loan after you do it? Yeah, absolutely. Because the way the industry typically makes their money is through a thing called service release premium. So Fannie Mae and Freddie Mac will pay us a premium to let them own the loan. Okay, so that's how we typically make our money. And then they'll go out and find another servicer to come in and buy the rights to collect the payment.
Mm-hmm.
That's what the servicing is.
Mm-hmm.
Most lenders out there, the big money center banks, don't own their own mortgages. They're just servicing them on behalf of the bigger agencies, and they're paid a fee on an annualized basis to collect that money. So we just elect to collect it up front, give it to them, let them deal with it afterwards.
Okay, this actually reminds me of a pandemic-related question, because from the CARES Act, it granted the people the right to forbearance. And now I'm thinking, okay, so if people are not paying their mortgages, what happens to the mortgage servicing company? Because they still need to pay whoever owns the loan, right?
Correct. And that's where the problems hit. Back in, I believe it was April, late March, April, when the CARES Act came out, the mortgage servicers were caught off guard, because what happens there on that end is they collect the monies from the consumer. Okay. If the CARES Act essentially gave the consumer the right to forbear, to give up the need to make a payment today in the short term, due to any financial constraints that they're experiencing as a result of the pandemic. We can come back more to that in a second. But the servicer still has to make the payment to the owner of the mortgage, in this case, Fannie Mae or Freddie Mac. So if the consumer is being told they don't need to make the payment, but the servicer still needs to make the payment, then there becomes a run on their portfolio of cash, because they're making payments without receiving them. So as a result of that, when we saw a spike, we saw in a matter of a 2-day period, a spike from rates in the low 3s to upwards of 5%. It's because the servicers no longer can pay the premiums that they were paying the Fannie Mae and Freddie Mac to buy the new loans, which meant it was being passed on to us, which means the rates in the secondary market of the consumer had to go up to make up for it, to keep the flow of the market going. So, because remember, it doesn't stop there at Fannie Mae or Freddie Mac either. It goes on to the investment banker, then it goes to the broker yourself, then it goes to the consumer who can buy the mortgages as a mortgage-backed security. And if I'm that consumer, I got to get my interest that I bought to pay. But if on the front end, the consumer's not paying, how is that money going to transition to me?
Because it's all connected, right? You can't just remove one piece and not expect everything to continue functioning.
So then basically the agencies, the FHFA came back and said, okay, we're going to limit the exposure for the servicers to a set defined period where they got a front. Then they're able to transition it back to Fannie Mae and Freddie Mac. And then the markets started to stabilize again.
Did you actually see, from your point of view, a lot of people requesting forbearance?
From our point of view, we didn't see a lot. We had a number of discussions, but where a lot of the confusion really came into the consumer is, again, the poor communication from the FHFA in regards to who was able and qualified to file for forbearance. Because they knew they had to do something quick, and we all commend them for acting quickly once COVID hit and the stay-at-home piece started in place, but they just didn't think it through properly. We had, for instance, I had a customer call us and say, hey, I'm calling about the possibility of forbearing on my loan. And my first reaction was, I'm so sorry for you losing your job or having some sort of financial stress where you can't make your payments anymore. He goes, oh, no, that's not the case. I just figured if they're letting me miss the payments, I can take that extra cash and build the deck on my house. And that's not his or her fault. It's the lack of clarity that was transitioned all the way down to the consumer. So until that clarity was provided, you saw this massive gyrations in the marketplace, from the consumer to the servicer to everybody involved with the transaction, which caused a big issue, for sure. But you commend them. They had to act quickly. They acted quickly. They saved a lot of families from the unfortunate troubles they've gone through. It just wasn't thought out properly. So.
Well, Mike, we're coming to a close in our time here. I really appreciate, again, your time. I did have, out of curiosity, I guess I was just curious, as a fellow business owner myself, how have you guys, your staff have been doing during this whole pandemic thing.
Yeah, you know what? I got to commend my staff. I mean, I'm one of 4 partners here, and they've done such a tremendous job transitioning, pivoting from at work to home during a time where it's as volatile as it was early on, to the massive influx of business due to everybody in the world trying to refinance and save some money. That it really, I commend them all. They've done a yeoman's job at that. It's been phenomenal. But you know, the paradigm shift that's happening here is, I don't know when we'll all go back to normalcy, the way we used to see it, and be back in the office. And 2, I don't know if I ever need to require anybody to come back to the office anymore. You know, because they're doing so well. And what's very important to us is their peace of mind. You know, being able to work at home, save the hour drive each way, 45 minutes, avoiding the angst and frustration of traffic, you know, when they can be more purposeful with their time at home with their families. And in the end, they end up working more, which as a business owner helps us. We pay a lot more overtime, but you know what, we're okay doing that with the job they're doing.
I'm really glad to hear. There's always that. It's interesting because when I was still going to our office before COVID in DC, I would probably work maybe say 30% of the time from home. And I was like, I wish I could work from home more. And now it's been granted. And I think it works well for a lot of people. There are some things that might work better for.
It's not for everybody, but I mean, I think look, how many Zoom calls have we all been on over the last several months? I think it's Zoom fatigue for sure. But you know what? I think that really is the new normal.
Right.
You know, and I encourage everybody, take advantage of the video capabilities to talk with your advisor, your mortgage lender, to have these kind of discussions and be able to look in their eyes still and have that healthy conversation that we normally would have outside this pandemic.
Got it.
You know.
Well, thank you so much again, Mike, for your time and for your wisdom and insights about the whole mortgage lending.
Thank you for having me. I've enjoyed it. Anytime you need anything else, I'm here for you. I appreciate your time as well. Stay happy and healthy, and sanitize.
Wash our hands. All right. Have a good one, Mike.
You too. Bye-bye.
Bye.